Wednesday, December 18th, 2024, Maneco 64, home of alternative economics and contrarian views. We're going to look at the UK debt time bomb. Yes, I've been warning about this for 8 years, and I think it's about to blow, unless, of course, and that's what we're going to look at today, unless, of course. And you might be asking, well, you've been warning it for 8 years, it's not happened. Well, it's because the maths never lie. Mathematics never lie. Yes, central bank officials, government officials can always manipulate things, but eventually the math or reality catches up with markets and with the debt. And one of the reasons why I've been warning about this is that historically, when countries try to keep going a debt-based system or a fiat currency system, yes, they can keep doing it for a long time, especially if other countries are doing it, but eventually it blows, the system blows. And one of the books that I've recommended throughout the 9 years that I've been posting here on YouTube is this one here, Fiat Money, Inflation in France by Andrew Dickson White. And I read this book over 20 years ago, and I knew that's where we're going. Yes, it's taken longer. The seeds were planted quite a long time ago, just over 100 years. And before we go into further detail, I just wanted to thank all of you. We did go over 100,000 subscribers before the end of the year. And I'm happy about that. As I said, it's not my objective, the number of subscribers. Yes, earlier this year I got this silver plaque from YouTube for reaching 100,000. So it's going quite quickly now. Hopefully I'll keep producing content that you find valuable, content that reaches more and more people, because the topic I cover is very dry, as my wife tells me, but it's very important. So I'm gonna go back a couple of 100 years, maybe a little more. It's always very good to go through history to learn about history. Of course, history doesn't repeat exactly, but it rhymes. I think it was Mark Twain. Someone said that. Someone much smarter than me. Just over 200 years ago, Europe was in the middle of the Napoleonic Wars. The UK suspended the gold standard in 1797 in order to fight that war. And what does that mean? Well, that means that the gold and the silver that circulates, also the monetary system in the country domestically, is protected so it doesn't go out during times of war. So people domestically have to pay with paper, not real money. That's fiat currency. Yes, and then Napoleon bit the dust at Waterloo, and then eventually Britain went back and convertibility was restored. And up until 1914, the pound was as good as gold, as good as a sovereign, never changed. And inflation averaged, or the CPI averaged minus 0.1 from 1821 to 1914. Yes. For those who think we need inflation for economic growth and for the economy to do well, think again. I don't think Britain did badly in the 19th century and in the run-up to World War I. And one of the things that happens during wars, and it happened during the Napoleonic Wars, is that the debt goes up massively. But as you can see here, the national debt from the end of the Napoleonic Wars until the beginning of World War I actually went down in nominal and real terms, and it was down to 650 million before the outbreak of World War I, and it went up more than 10 times. It was at 7.4 billion by 1919. That's why Churchill had such a big problem going back on the gold standard at the same rate prior to 1914, because there's too much money in the system. He went in at the wrong rate. It failed in 1931. And ever since then, or ever since 1914, it's been uncontrolled debt. Yes, up until 71, it was a little bit more under control because the US kept an anchor for the whole world's monetary system through the Bretton Woods gold exchange system. It wasn't a pure gold standard, but after 71 as well, the anchor was completely removed. And it's one of the reasons I've been warning about the debt, because the debt is growing a lot faster than the economy. Bond yields or interest rates, they had their day in the sun, the bond market, from 1981 to 2020. And now the bond vigilantes are back. And I venture to say that a lot of young people who are in the markets, who are in their 20s and 30s, maybe even early 40s, they don't even know about the bond vigilantes. On the other hand, I started in the markets when bond yields, long-term bond yields, were double digits or in the high single digits, like 8 or 9. So it's nothing really impossible. Some people seem to think we're going to go back to 2%, 3% long-term bond yields. I think they need to wake up and smell the coffee. So I think, yes, the UK is in trouble. The bond vigilantes are back. But it's not just the UK. It's the whole of the West, the US included. We're going to talk about the US in another video. They have even bigger debt problems. But there was a political advisor to Bill Clinton in the early 90s by the name of James Carville. And he said the following, and I quote, "I used to think that if there was reincarnation, I wanted to come back as the president or the Pope or as a 400 baseball hitter. But now I would like to come back as the bond market. You can intimidate everybody." So what does that mean? Well, back until early 90s, the bond market was in control. And all of a sudden, the cycles helped the borrowers, helped the governments, and it helped the corporate sector, the consumer sector, because yields were on a downward path, bond prices were going up, and we had the everything bubble, and that ran into 2020. And that also meant that central banks could come in and do massive amounts of QE, which is basically money printing. And what they do is they print the money, or if you want to be technical, they create reserves on their balance sheet out of thin air, and they go into the secondary bond market. Just after governments issue in the primary market, they go in, buy these bonds, drive the price higher, and drive yields lower. So what that did, that put the bond vigilantes to sleep the last 30 years, because speculators, hedge funds, pension funds, they knew the central banks were coming in to do the QE, to print the money. So they front run the central banks, and in a way they did the job for the central bankers. But now, unfortunately for them and for borrowers, things have changed. The cycles turn. And in my opinion, bond yields are never going to go, well, not never, but not in the next 20, 30 years. They're not going to go back to the levels we saw recently, prior to COVID or during COVID. I mean, at one point in 2019, I think that there was $17 trillion of government bonds that were had a negative yield. So yes, if you bought those bonds at maturity, you'd get less. Those are bonds like in the EU, Swiss government bonds. But now everything's changed. And this morning we just had some what they call, the mainstream calls inflation data, but they're actually price data for the UK. And yes, they were a lot higher than the 2% target the Bank of England has. It was 2.6%. The RPI, which is an old measure of inflation, as they call it, that came out at, let's see here, RPI 3.6. The core CPI came out at 3.5. Yes, despite that, recently, the governor of the Bank of England has said that they expect to cut rates 4 times next year. And tomorrow, I don't think they'll be able to cut. Who knows? But if they do cut, I think the bond vigilantes are about to wake up. Or if not, I think they're waking up already. They're just flexing their muscles. They're getting warmed up for the main session, to really come back from the dead. But I said, unless, right? What's the unless? Well, the unless is that this man here, Andrew Bailey, the governor of the Bank of England, decides to do QE again, to print more and more money. And why would he do that? Well, to keep the bond yields, the gilt yields, under control, not to allow it to break through these key technical levels. And I worked in the bond markets for over 20 years, and the bond markets are the biggest markets out there. They set the tone for the whole financial system, for the stock markets, because it's the price of credit. And I can tell you that the technical picture, aside from the fundamental picture, doesn't look very good. And remember, higher bond yields are not good. That means that old bond prices are going down because new bonds issued by the government earn a lot more than the old ones. So the price of the old ones have to adjust lower to yield the same as the new bonds. So that's the trick about bonds. It's not complicated. And the other thing that's hurting the bond markets, we've seen recently, the UK economy is shrinking. Business confidence is down in the dumps completely. The current government, not that they could have solved anything, but they took completely the wrong road, in my opinion. They're punishing more and more the productive part of the economy, the private sector. And it's going to kill the whole economy. They're going to get less tax receipts. And I think the bond vigilantes, in my opinion, are going to punish the government with higher rates. They're going to sell bonds, and that's going to create a vicious circle. This guy here, Andrew Bailey, comes out and starts printing trillions to buy the bonds to keep the rates low. And you might think, well, he can do that. That's perfect. No problem. Well, the only problem is that we then get to a point of the crack-up boom, of which Ludwig von Mises warned about, and I've spoken about many times on this channel, and I'm going to put it up here. You can pause it and read the whole thing, but the gist of it is that there comes a point where the general public, the masses, realize that the policy of inflation is deliberate. And by policy of inflation, I mean money printing, not the CPI. CPI is a consequence of it. And then they realize that the government and the central bank are never going to stop inflating. They cannot stop inflating. And that's part of the maths and the debt-based system. And what they do is they get rid of the currency as quickly as possible. The demand for the currency drops drops massively, and all that means is that the currency becomes worth less. And if your currency is worth less, the mirror image of that is higher prices. But this is a psychological thing. This is like a hyperinflation is not a cost push-based phenomenon. It's a psychological thing. It's when the masses wake up and realize that inflation is not caused by Putin or anything else. It's caused by the government, and they're going to keep doing it, and people lose complete confidence. So that's what will happen if Mr. Bailey starts QE again, or if he threatens yield curve control. Yield curve control, of course, is when he says, I will not allow the 10-year yield to go above 4.75 or 5%. And all that means if the market tests that level, the Bank of England will go in there and start buying. They will not call it QE, but it's as good as it's yield curve control. I think that they might try that, but the bond vigilantes and the foreign exchange market won't buy it. And why do I say the foreign exchange market? Well, because gold is traded in the foreign exchange market. It will punish the pound. And how would that happen? Well, the pound will drop even more versus gold. So that's the reason why I've been trying to stack as much gold and silver as possible, because I knew this was going to happen. It's just maths. And interestingly, maths was not my top subject in school, but working for over 20 years in the financial sector, you get used to it. So don't just tell yourself, oh, I'm not good at maths, I don't understand this. It's just a matter of compounding the numbers, right? And when the debt is compounding quicker than the economy can grow, well, there's a lot to pay, unfortunately. So we're going to stop right here. And as I said, this debt time bomb, even if they can kick the can down the road, it's going to have a massive consequence, and that's a lower value of your currency, a higher cost of living. And how is this going to affect the whole economy? Well, it's going to make it even worse, not just for the government, unfortunately, for people who are homeowners and have big mortgages. It's not going to improve. It's going to permeate down through the economy. So with that, I'm going to wish you all a very good day. Take care. Bye.